Good afternoon, ladies and gentlemen. Well, very warm welcome to this week's weekly market review. My name is Benjamin Brody, Head of Research and Investor Education here at SIAS. With me this morning is our Senior Technical Analyst, Sunny So. Very good morning. We're going to get started. The disclaimer is that, as usual, SIAS is not licensed by MAS. We are a registered charity. So whatever we talk about today, especially for specific stocks, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. Now, before we get to today's content, just want to let you know that the upcoming SIAS session for our SIAS members is slated to be on the 21st of June, Wednesday, 7 p.m. Because we love you and we hope you love us. Sunny and I are actually on holiday, so we'll be dialing in from a foreign country. Hopefully, that works out well. So this is the QR code. Do zap it so that you can choke your seat. Next is the SIAS membership. So this is going for $1 a month or $12 per year. And of course, gives you access to our investor education programs at a subsidized rate, as well as access to our popular monthly SIAS session where you can ask any kind of questions for analysts, and we'll try to answer it on the spot. Okay, let's say into today's content. This is, first up, we're going to be talking about the big tech valuations. This is a theme that we've touched on the week before as well. The reason why we're talking about it today is, of course, from late last week onwards, apparently the S&P 500 is again being pushed up and is mainly driven by the tech companies. Now, last week we've already discussed how the five biggest tech companies on S&P 500 actually make up about 24% of the market cap of the S&P 500. Which means that if you think about S&P 500, about 500 stocks, but the top five already make up 24%. Hence, when S&P 500 goes up or goes down, it's really a lot of times it's really driven by the big five tech companies. Now, if we're going to expand it a little bit, apart from the big five, we can look at the top 7 technology companies in the S&P 500, and we're going to look at it from a different matrix this time. We're going to look at it from a ratio perspective. So we're going to take the revenue and then we're going to divide it by the market cap. So this is the blue color one, so revenue divided by market cap. And the other matrix will be the net income divided by market cap. So it's just a ratio, yeah. So if we look at, let's say Meta, right, Facebook, the blue color line, what you can see is that the revenue per dollar of market cap is about 18%. Okay, for Tesla is closer to maybe 14. Nvidia is maybe about 4 or 5. Amazon is about maybe 42, 40, maybe 44%, so and so forth. All right. And we compare it versus the S&P 500, excluding the 7 tech companies that we've listed here. All right. So if you look at the blue color histogram over here, this bar is closer to about 6%. So which means that if you look at S&P 500 minus the 7 tech companies that we have here, the revenue per market cap ratio is about closer to 6%. While if you look at all the 7 companies that we're interested in, it's far, far lower compared to the benchmark. Which kind of gives you the idea that the market caps for all these companies have expanded quite rapidly compared to the revenue growth. So that's another way of saying that the valuations have gone up a little bit. Well, not a little bit, quite a fair bit. Now we can use the same analysis for the net income. So we take net income to market cap. Again, if you look at the orange color lines, for Meta is about 28%, Tesla is about 15 or 16, Nvidia is about 6 or 7, Amazon is closer to be about 5. And the comparison, again, the benchmark is about 6.1%. Again, it gives you the idea that market caps for all these 7 companies have expanded quite rapidly in the last few weeks. Hence, the ratio of revenue to market cap as well as net income to market cap has fallen quite low compared to the index. Now, so this is a real thing, right? As in, we've been talking about this so-called bubble in the technology companies at least for 2 weeks already. It doesn't seem to be stopping. I think this is really because the market doesn't have a lot of things going for it. Yeah, and therefore it's settling on the whole AI theme led by ChatGPT. That's why Microsoft is in there. I can tell you that if OpenAI is a public company, then of course it will also be shooting up somewhere, billions of dollars in market cap. But OpenAI is the, if you didn't know, is the company that made OpenAI. Yeah, it was one of the co-founders was actually Elon Musk, but he left quite a few years ago. It is a non-profit organization, but Microsoft has invested $10 billion in OpenAI. So it's not a public listed company, right? But if it is a public listed company, I'm sure it's going to be a very rich technology company as well. So the AI craze is still ongoing, right? Now, let's juxtapose that compared to the rest of the technology companies, which may or may not be AI related. If you look at the rest of it, and we have put them down into 4 different buckets. You've got technology, pure play technology, I beg your pardon, semiconductors, software and services, as well as technological or tech hardware. This is what I'm trying to show you is that this is the percentage of companies in the various segments that have slashed their second quarter guidance. All right, so the second quarter is not over yet to the end of June, and then we're going to have the numbers coming out in July, so on and so forth. The number of companies have already started slashing their guidance, so they're trying to guide the market down so that you wouldn't have a negative surprise. And if you look at for technology companies, about 40% of the companies in the technology space have slashed their guidance. For semiconductors, about 30%. Software and services is about 55%, I believe. So on and so forth. If you look at earnings per share, again, the guidance is slashed, so the average is close to about 48%, about 50%. So apart from the big tech companies, you've got a whole bunch of the companies in the technology space, and most of them as in close to more than 50%. We shouldn't say that. So it's a high minority, close to 50% of them are busy slashing their second quarter guidance. So as you can see, there are different parts of the economy not moving at the same pace, certainly for the technology companies. So take it as what you will. I think this reinforces the narrative that there are some specific companies in the technology space which is forming a little bit of a bubble simply because of the ChatGPT AI craze, and hence lifting the S&P 500. But really, if you look under the hood, the rest of the companies may not be doing so well. Now, that said, we've also been following quite closely to Bloomberg's own proprietary US equity model. Excuse me, I beg your pardon. And they do have this, what we call a market regime model. So red is the regime which is associated with poor expected forward returns. Yellow is associated with moderate expected forward returns, and green is associated with accelerated or much better expected forward returns. Now, if you take a quick look at this chart here, the blue color line is basically the S&P 500. So generally, you expect that the red areas will be associated with the points where S&P 500 went down, and green areas will be associated with the periods of time when S&P 500 really accelerated. And there's also going to be a bit of a lag. All right. So by and large, without even looking at the math, if you look at this chart itself, I think the correlation is relatively high. I mean, again, not perfect, so it's not going to be 100%. But again, as you can see, this part's here, where the model say there's going to be red. Really, yes, there was a downturn in S&P 500. Here was a drastic drop as well. Over here as well. But there are also some parts where the model did fail horribly. So, for example, here it's S&P 500 was predicted to go down, but it actually went up. This was a recovery from the pandemic period. Over here as well, this was for the year 2000, right? And again, the parts where it was green or yellow, yes, generally associated with S&P 500 going up. Now, the significance here is, of course, if you look at the last bit here, just very recently in the last week or so, based on Bloomberg's model, we are entering the yellow color regime. This is a very small sliver of yellow, maybe you cannot see it, but there was a long period of red simply because of the high inflation era, so on and so forth. And now the model is showing a little bit of yellow. Okay, so I guess from this model itself, it does indicate or suggest that we do have getting into calmer waters, moving ahead. So the whole inflation thing, the whole impact of it, as well as so-called US recession has been kind of baked into the data already. Yeah, and we're moving into a period of where we have a moderate fall returns, which could be one anecdotal piece of evidence that the market has turned and it might be safer to get into the water. Now, the last bit of information I want to share today is basically the disjointed picture between the smart money versus the retail people. So smart money is generally the term that we use for professional investors, institutional investors, sovereign wealth funds, so on and so forth. And retail will be, of course, anybody who goes on the online and buy and sell. All right. As you can see, in general, the retail investors tend to be more optimistic and bullish compared to the institutional and professional investors. And the professional and institutional investors tend to be more pessimistic compared to the retail investors. So in general, again, the vast majority of research that we've been looking through do suggest that the technology bubble is forming, and when it bursts, or if it bursts, it might drag the S&P 500 down by a rule of thumb about 20%, which is basically correction territory, which kind of makes sense from I guess, a philosophical as well as a theoretical perspective. But again, markets don't really adhere to theory, so it might be just moving ahead based on irrational exuberance. So we shall see. But again, on a more zoomed out macro perspective, it does look as though it is kind of time to consider when you want to enter into the market. With that, I'm going to leave it to Sunny, who will be talking about the Fed actions for this week, as well as perhaps some guidance on when we can dip our toes back into the water. Over to you, Sunny.
Okay, thanks, Benjamin. So exuberance, that is the word. So S&P 500 enter the have risen above 20% from the low of October. That was the headline on Friday. So going into this week, we are going to have the inflation data, the inflation headline numbers coming out, as well as the FOMC meeting and the interest rate decision. So these two data, I believe, will be causing a lot of volatility in the market going forward. So I'll come back to the charts again to talk about the levels of the S&P 500 as well as the major indices. So first, let's look at the CME Fed Watch 2. So current probability that we are going to have a sort of a pause in this month meeting on 14th of June is that some of the Fed officials have already said that they are in view that a pause is a prudent measure in case of accidental over-tightening. So that's why the probability is still staying around at 78% that we are going to have 0% or 0 basis point hike or a pause for this month's meeting. But then that is not the case that going forward, we will not see any more rate hike, because if you go to the July data over here, you can see that the chances of having another 25 basis point hike in July or even going forward is still there. So probability that we are going to have a pause for a long term is not factored into the market right now. Okay, it's just a pause for June for Fed officials to take note of how far they have come and what is the lagged effect of their interest rate hike. So we are also seeing that there might be a 25 basis point cut in December as well. So that is waiting for it to play out for the second half of this year. So for this month meeting, we are also looking at the dot plot chart, which we will have an update from the Fed meeting on Wednesday, 2 days meeting. So the Thursday, the results will be coming out. An updated dot plot chart will also be available. So are we going to move up the consensus of the peak rate? So it used to be around the 5.1 or where the bracket that we are in now, between the 5% to the 5.25. If you are going to shift that up, that will open the gates, open the door for further rate hikes to the second half of the year. So this is also a part of the data that market will be looking closely at as well, on top of the pause that we are looking for the June rate decision. So going to the data side, before the Thursday FOMC meeting here on the results on 15th of June, we will start the meeting on 14th of June. It's a 2-day meeting. We will also have the inflation numbers coming out. Okay, So headline month-on-month inflation number, consensus is looking at coming at 0.2. The previous number was 0.4. So if we don't have this significant 0.2% drop in the inflation data, then it could mean that the Fed might have more firepower to hike the rate again for June as well as July. So this is a number that will sort of sway which side the Fed will be voting on. So core inflation number expected to come in at 5.3 versus the previous number of 5.5%. And then year-on-year inflation rate is expected at 4.1% against the previous reading of 4.9. And then we have the FOMC meeting on Thursday. Consensus is that we are not going to have any rate hike for this month in June. We are going to stay at the 5.25% level. But this number or this consensus may change, and the probability that I showed just now may also change depending on the inflation data that comes here. So one of the things that I take note of was the Friday non-farm payroll data on the 2nd of June, where we have a very outstanding number here, 339,000 against the consensus of 190. So this is actually another sign that the Fed do have some room to hike further to bring down inflation faster rather than getting a pause for this month. So this is the uncertainty that we are into now, and it could sway the market quite a bit. Okay, on the Singapore side, nothing much on the calendar. So we are also waiting on what is going to happen in the US this week to see how the markets will move. But surprisingly, STI is catching up on the rally last Friday on US overnight as well as the Asian rally that we saw last Friday. Okay, and then let's move to the Dow Jones Index first. So key levels to watch for the Dow Jones Index, definitely you see a triple top red line over here. This is the resistance level that has been keeping or capping the Dow Jones gains since the beginning of the year. So this level would be the level to watch. The 4,281 would still be the resistance level if you're intending to go long. Okay. However, if you are on the prudent side, being more conservative, we can see that Dow Jones Index crossed above the 20 days moving average, which is the basis of that Bollinger Band. As long as it stay above the 20 days average, this uptrend to retest the 34,200 level is still intact. Else, you can use the October low as well as the March low, connecting both the low together. You may have an uptrend line. You can see that during the May period, this uptrend line was also upheld, and then market actually bounced along this uptrend line. If the Dow Jones Index come back down to this level, this uptrend line again, I'll not be surprised if market were to bounce at this level again, which is around the 33,150 points level. Looking at the indicators for the Dow Jones Index, you can see the MACD histogram is at reading of 91.63. That is a positive reading, hence a positive momentum in the Dow Jones Index. So we can also see that the MACD line is also diverging above the signal line, hence this momentum may still have some legs to run. So that means the uptrend might still continue towards the end of this week. And that means that the MACD is supporting the uptrend that the Dow Jones Index is displaying right now. The RSI reading at 59.75, 1 point short of the 60-point reading, is also pretty healthy, about 10 points above the 50-point neutral mark, hence also signifying that there is a uptrend, a positive uptrend momentum in Dow Jones Index right now, and this is also above the 14 days RSI moving average of 49.18. So it's quite a significant difference between the 14 days average and the reading that we have on Friday. So there is quite a significant amount of momentum right now in the Dow Jones Index. So I think for traders today, for this week, they'll be looking at the 20 days moving average to enter for a short-term trade. And then, of course, if we retest the 34,000 resistance level again over here, they might want to take some profit off the table because they might, like what Ben shared earlier, market might be overextended in the near term. So let's move to the S&P 500, which is causing the headlines on Friday. So you can see somewhere near the bottom of October last year, if I draw a line or a zone up here, all the way to the close of last Friday, we are up about 20.75%. So a 20% rise from the low that we see in October last year signifies that we may now be in a bull market or in the confirmation of a bull market right now. So the question now is, shall we chase this bull market or chase this uptrend? I would say that you can see from the S&P 500 since the low of October, market move in wave. So even if you want to chase the uptrend or get back into the uptrend that you see over here since the October low of last year, markets move in wave, it would be more prudent to wait for a slight pullback before re-entering again. So talking about pullback, what are the key levels that we should be looking at? The first level would, of course, be the 20 days moving average, the basis of the Bollinger Band at 4,200, this black line over here. And that coincides with the sort of the previous resistance level that we are watching on the S&P 500, which is a double or even a triple top kind of a resistance level around here, which is the high of February as well as the high of May, and that's around the 4,195 points level, which we have been talking about quite a bit of time. So we broke through that convincingly, and now we are at 4,324 points. So this resistance level may have a change in polarity and becomes a support level going forward for S&P 500 if the uptrend is going to continue, and this has found confluence with the 20 days moving average right now. Okay, on the conservative side, if you are looking to get back if you are thinking that a pullback might be more severe, then connecting the low of October as well as the low in March, you have an uptrend line as well. So this might provide further support for the S&P 500 if a deep pullback is going to be expected. Of course, we also have the lower bound of the Bollinger Band around the 4,078 points level, and that will provide further support for the S&P 500. Now, to gauge whether we have the momentum to push this rally that we see higher, we should be looking at the indicators. So according to the MACD indicator, we are still having a positive reading of 9.55 according to the MACD histogram. The MACD line is still quite a distance above the signal line. So definitely there is still positive momentum in the S&P 500 index right now. So the index is likely expected to stay elevated. However, the momentum seems to be slightly weakening because on the 7th of June as well as last Friday, 9th of June, you can see that the MACD histogram is actually coming down, which means that momentum might be subsiding or sort of a softening going forward. So positive uptrend, but the uptrend is weakening. The momentum is weakening right now, according to the MACD indicator. The RSI reading on Friday was 65.78, which is a very good kind of healthy momentum kind of reading. Hence, coincide with the MACD theory that the index still have a very healthy positive momentum, but this positive momentum, according to the RSI indicator, is pretty close to the 70-point mark, which is the overbought territory of the RSI, and hence a reversal or a pullback might occur if the RSI hit above the 70-point overbought signal. Okay, the 14 days moving average is at 59.82. So this is also, the current reading is also about 5 or 6 points above the past 14 days reading. Hence, this momentum can be read as a growing momentum as well. So for traders trading into the S&P 500, chasing the rally on a short term, you might want to look out for signal of weakening of momentum on the MACD, which means that the MACD line will converge towards the signal line. That is a sign of this start to take some money off the table. And if the RSI hits above the 70-point mark, which is the overbought signal, then a reversal is expected. You should also take some money off the table should that happen as well for both of the indicators on the S&P 500. Lastly, let's move to the Nasdaq Composite Index. So last week we talked about Nasdaq Composite Index. We have a bit of a consolidation over here. The previous resistance level connected the January high as well as the consolidation period over here between the April and May period. That was the level of 12,269 points. We have since moved up quite a bit over here throughout the month of May and June. And this resistance over here was actually the previous highs that you see in August last year. So we have come and test this level. You can see that the green and red candles, when it hits this level of about 13,181, you can see some of the traders starting to take some profit off the table. Hence, there's some red candle intermittent between the green candle. So this is a resistance level currently we are sitting at right now. And Nasdaq Composite Index actually closed above that at 13,259 points. So are we expected to go further up higher for the Nasdaq Composite Index? According to the indicators, you can see that a very significant sign, the MACD histogram is actually slowing down, which means that the latest reading at 23.39 is actually one of the lowest reading for the past 5 days, last week, or even at the beginning of June. So this momentum that we see now is weakening significantly, and the MACD line is converging towards the signal line. Hence, a crossover, if the MACD line is to go under the signal line, it would mean that a confirmation of a reversal, and we will expect a pullback of the Nasdaq Composite Index. Of course, if a pullback is going to happen, then this resistance level that we see previously, the January high around 12,269 points would definitely come into at a support. The 20 days moving average right now at 12,834 is still a bit near if we have a confirmation of a reversal. The RSI has actually moved into the above the 70-point mark, which is the overbought territory since last week. So this week we have a bit of a pullback. The RSI reading now is at 68.58. So we'll be looking closely at the trajectory of the RSI since that it has triggered the overbought signal. We want to see that whether the RSI line is slightly going to move downwards. The 14 days moving average of the RSI is at 67.96. So we are pretty close to what is the reading for the past 14 days. And this would also be another point to take note that the uptrend that we see now is actually starting to come down or slower down in the momentum that we see. Okay, so Nasdaq Composite Index, positive momentum still present. However, that positive momentum is actually starting to weaken quite significantly going forward. And if after this week, after the FOMC meeting and after the inflation data that comes out, there might be no catalyst to push the Nasdaq Composite up further. That means the Nasdaq Composite might have quite a severe pullback, I believe, around the level of 12,200. Some support is likely to come in. So moving on to the Asia side, we can see the STI today is catching up with the rally from last week. So we are up about 0.43% or 13%, close to 0.5% up for today's trading session. Now, which are the key levels to watch out for the STI index? So first thing first, lower bound of that Bollinger Band, you can see we have bounced that quite on 2 occasions on 31st May as well as 17th of May have provided some support on the lower bound of the Bollinger Band. So connecting the low of October as well as March, you have an uptrend line, and this uptrend line has been upheld during the May period where we start to test this uptrend line. So this uptrend line is still standing and it's going to provide further support for the STI going forward. So if the STI is going to have a pullback towards this uptrend line that you see in green over here, as well as the lower bound of the Bollinger Band at about 3,160 points, that would be a good area to get back into the STI index. For it to go back up to the near-term resistance, which is the upper bound of the Bollinger Band, 3,227 points, which is also the low of the December period. This used to be a support zone for the STI index. But if you are now from the price that we are in right now, or the index point that we are in right now, this support level can have a change in polarity and become a resistance level, which we have seen on 2 occasions in May this year when the index broke down this level and tries to go back up again. It has faced some resistance. So near-term target for the SCI index will be the 3,225 points level, which was the December low. Now, according to the MACD indicator, we have a slight crossover of the MACD line above the signal line since the early part of June, and that could signal that we are in the early phase of an uptrend or a reversal upwards from the downtrend that we see since the beginning of April. So we are still in the early part, so getting in on the support level would be a more prudent approach or a more conservative approach. The RSI reading on the STI index is at 47.15, which is still 3 points below the 50-point neutral mark. Hence, momentum is still weak. However, if we manage to cross above the 50-point neutral mark for the RSI index this week, the momentum on the STI index might accelerate and start to grow, and hence index might push above this support term resistance point and then use it as a support going forward again. And hence, if you look at this pattern kind of forming, it looks like a range bound kind of a formation forming, and of course, it also may go into a converging triangle kind of situation where a breakout would likely occur. But of course, the indicators right now, both the MACD and RSI, does not signify to us that a breakout is likely to occur because momentum is still weak, but it's rather a period where traders can accumulate position on the lower conservative side around the lower bound of the Bollinger Band at 3,160 points. So let's move to the last Asian market that we'll be looking at this week, which is the HSI index. So we talked about the March low for quite a bit of time, and then we breached that somewhere at the end of May period this year. So that's where I get into the Hang Seng index again. And index has still moved above that, and it also reached the low of around the 18,235 point level. So for a period of time, I was in the negative territory, but for the past 1 week or two, the index has moved back up and moved above the 20 days moving average on the Bollinger Band. That's a good sign to me, because when the candlestick move above the 20-day short-term moving average, it also means that it's going into the uptrend. It seems that it also signifies that further momentum might be building for the Hang Seng index. The resistance level to watch out for would definitely be this level over here, 19,900 or the 20,000 handle, because during this period, you can see that in the December period, it provides some resistance towards the Hang Seng index, and slightly above that at 20,183 points, that is the upper bound of the Bollinger Band, further adding some resistance level to the Hang Seng index. On the MACD side, the MACD histogram at 89.35 right now is pretty healthy. You can see that the crossover of the MACD line above the signal line around the 7th of June period is also pretty strong because the divergence away from the MACD away from the signal line is actually quite wide, and that means that momentum is healthy. And once it broke above the zero baseline on the MACD indicator, we could expect that momentum will start to grow further or accelerate further, and hence push the Hang Seng Index up to maybe even retest the resistance that you see over here, which is the April high that we see around the 20,800 points level. Of course, this would also depend on the inflation rate data after the FOMC decision that will be coming out this week. If all that is going in line or positive in the market, then 20,800 should not be a problem for the Hang Seng Index. On the RSI side, we are now on the verge of the 50-point mark, the latest reading at 50.05 against the 14 days moving average reading of 40.55 level. So that is a sign that RSI momentum is growing. You can see that this uptrend forming since the beginning of June on the RSI indicator. Now we have crossed above the 50-point mark. So this is another positive point that the momentum is going to continue going forward. So we still have some gap between the 50-point mark and the 70-point RSI reading of the overbought territory. Hence, there's still a lot of room for the RSI to sort of go up further before it hits the overbought signal. So that means that the chances of Hang Seng Index going back upwards is likely on track, and we may likely see 20,800 towards the end of June and even the early part of July. So with that, I think I have covered the most of the Asian indices for this week. Anything else to add, Benjamin?
Well, I just want to say that the China and Hong Kong markets are probably not going to be doing anything spectacular. As you can see, that China on a macro level is going through some growing pains. A lot of calls for them to increase their stimulus, I guess, package or to lower its interest rates as opposed to the Western countries. But I think a lot of it also depends on the real estate market. So the China Evergrande and all the kind of issues are still there. One of the major Western banks just came out with a report. So they expect an L-shaped recovery. So which means that if the real estate market in China recovers, right, then it's going to zoom all the way up. Now there was a separate report that kind of estimated that the real estate, we're talking about construction and all the related activities, make up about 20%, 20-ish% of the Chinese economy, which is huge, right? So if that recovers, then of course you're going to see a spring in the Chinese onshore as well as Hong Kong market. So as the chart shows, it's still in the downtrend, but you can watch for it. All right, so with that, thank you very much, Sunny. I hear you're going on a vacation next week, or is it the week? Yeah, next week, yes.
Yes, go for vacation next week, and then hopefully I can extend it to another week so that I can join you on air on the SIAS session live in an overseas country. Hopefully the Wi-Fi is strong enough, and then we can still answer some of the viewers, the questions from the viewers for that session. Yep.
Okay. All right. So good stuff. Thank you very much for joining us today. We're signing out. So have a great week ahead.